Have you ever heard the news talk about the Fed cutting interest rates and wondered what it actually means for you? It sounds complicated, but trust me, it's not as scary as it seems. Let us break it down and see who really wins and who loses when the Federal Reserve decides to make money cheaper to borrow. First, what even is the Federal Reserve, or the Fed? Think of them as the central bank of the United States. They have a big job, keeping our economy stable. One of their most powerful tools is the federal funds rate. This is the interest rate banks charge each other for overnight loans. When the Fed cuts this rate, it creates a ripple effect across the entire economy, influencing everything from your savings account to your mortgage. So, why would they cut rates? Usually, it's to give the economy a boost. When rates are low, borrowing money becomes cheaper. This encourages businesses to take out loans to expand, hire more people, and invest in new projects. It also makes it easier for regular folks like us to get loans for big purchases like a car or a house. Think of it as the Fed hitting the gas pedal on the economy to speed things up, especially if things are looking a bit sluggish. Now, let's talk about the winners. Who gets the biggest slice of the pie when rates go down? First up, borrowers. This one's a no-brainer. If you're looking to buy a home, a rate cut is fantastic news. A lower interest rate on your mortgage means a lower monthly payment, which could save you tens of thousands of dollars over the life of the loan. The same goes for car loans and personal loans. Even your credit card interest rates might dip a little. So, if you've been waiting to make a big purchase, a rate cut could be the green light you've been looking for. Next, the stock market often loves a good rate cut. When borrowing costs are low, companies can grow more easily, which can lead to higher profits. Investors see this potential for growth and get excited, often pushing stock prices up. Companies with a lot of debt also breathe a sigh of relief because it becomes cheaper for them to manage that debt. So if you have a 401k or other investments in the stock market, you might see a nice little bump. Homeowners with existing variable rate mortgages also win. Their monthly payments could go down without them having to do anything. And for those looking to sell their homes, lower mortgage rates can bring more buyers into the market, potentially pushing up home prices due to increased demand. But it's not all sunshine and rainbows. One has to be on the other side of the equation. So who loses when interest rates are cut? The biggest group here is savers. If you're someone who diligently puts money into a high-yield savings account, a CD or a money market account, you'll feel the sting. When the Fed cuts rates, the interest you earn on your savings goes down, sometimes to almost nothing. It can be frustrating to see your nest egg growing much more slowly. Your hard-earned cash just doesn't work as hard for you in a low-rate environment. Retirees and others living on a fixed income also face challenges. Many rely on the interest from their savings to cover living expenses. When that income stream dries up, they might have to dip into their principal savings more than they planned, which can be risky for their long-term financial security. Another potential risk is inflation. When borrowing is cheap and everyone is spending, demand for goods and services can outpace supply. When too much money is chasing too few goods, prices go up. That's inflation. It means your dollar doesn't stretch as far as it used to at the grocery store or the gas pump. The Fed has to walk a tightrope, stimulating the economy without letting inflation get out of control. As you can see, the Fed rate cut is a double-edged sword. It's a powerful tool designed to help the economy, but it creates different outcomes for different people. If you're a borrower or an investor, you're probably cheering. If you're a saver or a retiree, you might be a bit more concerned. Understanding this dynamic is key to managing your own finances. When you hear news about the Fed, you'll now have a better idea of how it might affect your wallet, your investments, and your future plans. It's all about knowing where you stand in the economic puzzle. I hope this helped clear things up. It's a complex topic, but knowing the basics can make a huge difference. If you found this video helpful, give it a thumbs up and hit that subscribe button for more simple explanations of complex money topics. Thanks for watching, and I'll see you in the next one.